All right, we have more changes unfolding in the U.S. financial system, changes that have us racing toward a $5+ trillion wall of corporate floating rate debt. This is separate from the commercial real estate problem that we're all aware of, different problem, different asset class, but the same underlying issue, an issue that's been percolating in the background now for over a year. We've been trying to bring attention to this for months. Well, Goldman Sachs just published a note warning their clients about the impact it may have, when it will happen, and how wide of a net it may cast. And that last point is the most shocking part about this. Number of public companies in the crosshairs is something that I didn't expect. Look, the Fed wants to slow the economy down right now, right? They want unemployment to rise. Well, they're about to get their wish. But before we get started, if you're not already a subscriber of this channel, consider subscribing. It helps the channel out, and I appreciate your support. So we've been talking about how tighter lending conditions combined with these higher rates is a recipe for disaster. We've been focusing on the real estate market primarily as it's the most interest rate sensitive sector of the economy, the first to feel the effects. And we all know how bad it's hitting CRE right now. Commercial real estate is in a full-blown crisis right now. You could see headlines like these almost every day. Another office building either defaulting on its loan obligations or handing the keys back to the lender and just walking away. And we've seen, for example, Starwood do that like a dozen times already this year. In other cases, you have properties selling for remarkable markdowns, a fire sale. That's what this is. In specific markets, property owners facing a maturing loan, dumping their building for 50, 60, 70% below market value, as nobody's touching commercial real estate right now. Office buildings specifically, but it's not just real estate that will bear the brunt of this. We've been seeing it already with all the bankruptcies and credit downgrades, company after company filing Chapter 11 or sometimes shutting down entirely, like in the case of Yellow Trucking last week. Well, like we were warning about last year with the wall of commercial real estate debt barreling down, we have something very similar happening right now, but this time with corporate debt. And the reason is simple. It's the same reason, in fact, the same underlying issue that's causing the CRE market to crack. The Fed's higher overnight rates combined with them choosing to suck money out of the system, causing banks to tighten their lending standards, drastically reducing the amount of new loans that they're able to write, being exceptionally picky with who they loan to, and changing the terms of existing loans as well, making them more favorable to the lender, to themselves. Same problem, same outcome, just a different victim. All right, victim's definitely not the right word, but you get what I'm saying. So check out this new piece from Goldman Sachs, just published a few days ago, titled "The Corporate Debt Maturity Wall: Implications for CapEx and Employment." Notice the last word in this title, employment. Very important to highlight this because none of this is going to stop until employment turns into unemployment. As much as financial media love to put forward their bullish perspective and play down any danger for the markets, the truth is they've been telling you that the Fed's going to pivot and we'll see rate cuts since like last year. Hell, at the end of 2022, the betting markets had the likelihood of the first Fed rate cut at 90% for July 2023. That's last month. They were wrong. They've been wrong this entire time. The truth is the Fed likely won't be cutting rates until the labor market breaks upward, until we see the unemployment rate greater than 4%, anything under 4, and we're looking at a higher for longer policy. We've talked about this plenty in past videos, and surprisingly, T.S. Lomberg just put out a piece saying the exact same thing, published on Friday, August 11th, titled "Fed to Keep the Overnight Rate at 5.5% until Unemployment is Greater than 4%, Not What the Market is Thinking." We've also showed you as well Bank of America's chief economist Hartnett, who we like a lot on this show, by the way, saying the exact same thing multiple times. Point is, we have a record low unemployment rate right now, sitting at 3.5%. That number has to rise considerably before the Fed changes course. They're going to pause rates, which is fine, but changing direction, cutting, isn't something they're going to do lightly. So how long will this take? How much longer do we have to wait? Well, that's exactly what we're about to find out in this Goldman Sachs piece, or at least get a clearer picture of. And by the way, this piece gets better and better as we go on with it. So here's what they say. The Fed's tightening cycle has pushed marginal funding costs for businesses sharply higher over the past couple of years, with yields jumping almost 5 percentage points for high-yield bonds. If interest rates remain this high, companies will need to devote a greater share of their revenue to cover higher interest expense as they refinance their debt at these higher rates. We explore the magnitude in this piece of this looming increase in interest expense and the potential impact on capital spending and employment. Now listen to this. The path for interest expense depends on future refinancing needs and interest rates. Refinancing needs for businesses will remain historically low over the next 2 years. Only about 16% of corporate debt will mature over the next 2 years. So what the hell are they talking about here? Well, check this out. What we're looking at is all of the corporate floating rate debt, meaning the debt that will see interest rates change the next time that the loan resets. Look at how little of it is maturing this year. We're only right here, folks. Thus far for 2023, just $230 billion in corporate debt has matured this year. And already we've seen this outrageous volume of corporate bankruptcies in 2023. More bankruptcies, in fact, that happened just in the first 4 months of this year, from January to April, than all of last year combined. That's only with just this little teensy bit of corporate debt coming to maturity. Well, look what's coming next year. 4 times the number as we've seen so far. Look at 2025, over $1 trillion of corporate loans reset. 2026 even more, and it continues until 2028 like this. So what does this mean? Well, it means all the companies whose loans aren't coming due for a few years are extremely lucky, but the corporations who do fall in this bucket for the rest of 2023, 24, 25, a portion of them will end up defaulting on their loan obligations and likely need to file for bankruptcy. And the portion is much higher than you probably think, much higher than I thought. I'm going to show you that in a minute. And the reason, well, this is the reason right here. Your company's current loan, for example, has an interest rate of, let's say 3, maybe 4%, right? Well, if your loan was to mature right now, today, or any time this year, or even next year, you're looking at a new rate of 9, 10, hell, maybe even 11, 12%. Now, the only reason this is even an issue right now is the higher rates, and obviously won't be an issue any longer when the Fed finally pivots, changes direction, stops raising or holding rates at these levels, and decides to drop the Fed funds rate down a few points. But like we said at the beginning of the video, that is not likely to happen until unemployment rises, until we see a more normal unemployment rate. 3.5% is just bananas. And from what I hear, the goal is to reach around 4%. The problem is that it's much easier said than done, because once you break the labor market, all bets are off, folks. It's like having a tiger on a leash, right? There's no telling if it'll increase just a half point to 4% or jump 3 points to 7%. So there really is a fine line at this stage in the Fed's monetary policy, walking a tightrope right now. Well, according to Goldman, they did the research, investigated the numbers, and came up with this. Here's what they say. We find that for each additional dollar of interest expense, firms lower their capital expenditures by 10 cents and labor costs by 20 cents. Let's read that one more time. We find for each additional dollar of interest expense, firms lower their CapEx by 10 cents and their labor costs by 20 cents. So 20 cents for every dollar, and about half of which comes from reduced employment and half of which comes through lower wages. Now, the scary part about this is the number of companies, especially public companies, who will be able to survive this. You'd think public companies should have a substantial cash buffer, a profitability buffer to withstand a sudden surprise expense. But like we saw with Yellow Trucking, many of these companies have substantial debt loads. And what's even worse, the number of unprofitable public companies, businesses that make no money, and we're not talking about an Amazon here, folks, who chooses to reinvest, in CapEx, their capital expenditures, to grow more, bringing their net profit back to baseline. We're talking about companies who legitimately make no money. Take a look at this. Look at the share of all publicly listed firms by profit margin. The light blue and dark blue stack sections at the bottom here are negative profitability. The dark blue, over 40% of all public companies are very negative. So the question is, how many of these dark blue, very negative companies are about to see their loans reset? Stay tuned. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.